This is Andy Hecht for the Martin Chronicle with a weekly update. I'll go over first my article that was on Seeking Alpha on September 8th called Bitcoin is for Real, and it's all about the flow. And we have a chart of Bitcoin up here, a 3-year daily chart, and you can see that it's really come down. And for me, Bitcoin is a really interesting concept. I come from a generation where, hey, there were no cell phones. We went to the library to do research. The world has changed dramatically, and I am kind of what one might call a technotard. I am very slow when it comes to modern technology. But Bitcoin is really interesting for me. And this whole cryptocurrency thing is really interesting. The original concept gave birth to something that solves a much bigger problem for the world. But just a little bit about Bitcoin. Bitcoin is a digital currency. It's transferred by computer. Each node, which is a computer, it's the best way to look at email is Bitcoin is its email for money. It's internet money. Now, the beautiful thing about Bitcoin is that Bitcoin comes with a back office, a trail, a ledger of every owner, and it's very, very transparent currency. So this is a very interesting thing. And Bitcoin itself, I think Bitcoin will be supported because of its back-end technology. But what I think, and what I wrote about in the article, and I encourage you to read it, it's on Seeking Alpha. Again, Bitcoin is for real, and it's all about the flow of money. And it's that latter part. It's all about the flow of money. In Wall Street, in finance, the front-end trading systems are par excellence when it comes to technology. And I believe that what Bitcoin back office technology is going to do, it's going to do what high frequency trading did for trading for the back office. It's going to make it a lot faster. It's going to cut expenses because the back office on Wall Street and in banks is still very much behind the times. And this Bitcoin, and it's called blockchain technology, is going to cut down settlement times, cut down the risk on transactions. When you cut settlement time, you cut the risk time on a transaction. And I think that this will make initially Bitcoin actually go higher. Bitcoin's trading around $241 per Bitcoin. It's down from over $1,000 in late 2013. It's a quarter of the price. And I think Bitcoin could have important ramifications for the gold market in the future. Bitcoin is a global currency with a traceable system, and Bitcoin is really the back end system. And a big company in this space just hired as their CEO Blythe Masters, who is a Wall Street prodigy. She developed the credit default swap. She's done a lot of things in terms of commodities. She ran all commodities trading for JP Morgan. She's been involved in the lending side, and now she is going to bring this blockchain technology to finance. And this is important for business around the world. So the takeaway here is really that the Bitcoin revolution is really about the back office technology, and one should not discount it. It's going to be very interesting going forward, and Bitcoin is truly global money. The only other global money out there, pan-global currency, is gold, and Bitcoin serves that purpose. So very interesting technology. Read the article, and if you have any questions, you can always email us at the Martin Chronicle. I have an article out on Seeking Alpha that came out on September 8th, which is called "The Market is Starving for News from China." And I don't know if you're like me, but I love Chinese food. And every time I eat Chinese food, the same thing happens. 2 hours later, I'm hungry again. And I mentioned that because that's what's going on today with the market. The market, after a piece of news comes out of China, an hour later, they're starving for the next piece of news. Now, the market in China has been very interesting this year, as the chart of the Shanghai 3-year daily shows. We had a huge rally in this market, and then economic weakness hit China, a slowdown. And a slowdown in China. China is still growing. It's just growing slower. The government targets 7% growth. And this year, the government's been pulling out all the stops to do something, anything for 7% growth. They've cut interest rates 5 times in 2015. They floated an infrastructure bond, a trillion yuan infrastructure bond to stimulate domestic construction activity. When the stock market really crashed back in July, as the chart shows, what happened was the government came in and put new rules and regulations on stock ownership. Sellers can't sell if you own more than 5% of a company. But basically what the government did is they initiated new rules and regs designed to inhibit or encourage or demand buying. And it settled the stock market briefly, but it's continued to go lower. So 7% growth is the target, but China's having a tough time reaching that. Goldman Sachs came out recently and said that growth this year is only going to be 6.8%, which is for the market. And in 2016, it's going to be 6.8 this year, 2016, 6.1%. So, this is a very difficult situation for the Chinese market, and we're seeing contagion. The contagion we see in the Dow Jones Industrial Average. On Monday, the 24th of August, the Dow Jones Industrial Average dropped 1,100 points within the first 4 minutes after the opening, and that is because of contagion from China. We have seen commodity prices go lower. Why? China is the demand side of the equation in commodities, and slower growth in China means less demand for commodities. So this is a continuation of in China. There's other things going on in the world too. Certainly Mario Draghi last week expanded quantitative easing by being able to buy more, lifting the amount of debt of member countries that the ECB could buy from 25% to 33%. This shows a problem in the economy of Europe, which continues to slow, not to mention a very difficult humanitarian crisis that Europe faces, which is slowing their growth, which is coming from the immigration issue, with all the people flooding, the refugees flooding into Europe from North Africa and the Middle East, countries like Syria and Iraq, where there's ISIS problems going on. So Europe's suffering, China's suffering, Russia continues to suffer under the weight of sanctions, the Middle East continues to suffer because lower oil prices. Other countries like Brazil and Australia are suffering economically. The U.S. continues to grow at a moderate pace. But this is all bad news for the markets, and is going to contribute to volatility in markets. And right now, the focus is on China. Really all about China, and we're in a bear market for commodity prices. But the takeaway from the article is be careful and watch out. China needs commodities. They have almost 1.4 billion people in China. They are the largest consumer of commodities in the world, and they're very savvy buyers. This commodity bear market will end when China comes in and buys. And the contagion's important. You could see on the chart of the Dow Jones Industrial Average what happened on August 24th. That is not a one-off. We're going to see continued volatility in the U.S. stock market coming down the pike because of what's going on in the world. And the devaluation, the Chinese government, another thing that they did in order to spur growth is since the dollar is in a big bull market since last year, it was up 27% between last May and this March, the yuan, the Chinese currency, which is pegged to the dollar, became very high along with the U.S. dollar, which thwarted China's ability to export. So China devalued their currency, suddenly shocking the market, as you could see from the spike on the chart. I believe that that's the first of many devaluations for the yuan to spur their export business. So very interesting thing going on there. China will eventually determine the bottom in commodity markets, but right now the market, like it's just had a big Chinese feast, which is always delicious, is starving 2 hours later for another piece of news out of that country, and that news will turn into volatility for all markets because of contagion. On September 8th, I had an article come out about natural gas on Seeking Alpha called Natural Gas, Another Episode in Boredom. It's now September, the summer's over. Summer tends to be a down time for natural gas. In fact, in 12 of the last 15 years, the price of natural gas moved higher in September and October than August prices. But natural gas continues to sit around the bottom end of the trading range, which is about $2.60 per million BTUs. And analysts and traders are bearish. They're bearish because there's no market action in natural gas these days. They're bearish because of the huge amounts of reserves from the Marcellus and Utica shales, which are said to contain over a quadrillion cubic feet of natural gas. That's enough to make any fundamentalist bearish. Meanwhile, open interest in natural gas futures has dropped to 927,000 roughly contracts, which is on the lower side, the lowest in quite some time. Volumes are dropping. But if we looked at a longer term chart of natural gas, you'd note that prices under $3 are very, very cheap. If we go out on a quarterly chart or an annual chart, you'd see that, the price 80% of the time since natural gas futures started trading, natural gas has been over $3 per million BTUs, and something like 50% of the time it's been over $4. And remember, the price at 265 per million BTUs, that is close to the lows. It can't go lower than $2.65. But the highs were about $15 in the wake of Hurricane Katrina in 2005. And in 2008, it got up to $13 per million BTUs. And most recently, 2 winters ago, we got up to $6.50. So the price is cheap here. And that's one of the key reasons that I think it's going to do okay. The commodity held up well this summer. They had every chance to crush it below the 260 support, but the bears were not able to do that at all. And there's other reasons that I like natural gas. Reason number one, U.S. rig counts have dropped dramatically in natural gas. Last year, natural gas rig counts were at 340 in the U.S. This year, they're at 202. So that means less production. You need rigs to produce. Second reason, coal is dead for power generation. That means that there will be natural gas will be used. That is an increase in that demand vertical. Third reason, liquefaction. Natural gas will be liquefied for transport on vessels to Asia, and that will add to the demand. So we know about the supply. There's a lot of demand verticals that are coming in. The price is very cheap. I'm not looking for the price to go back to $10, but I think that this winter, if we have a little cold spell, we're likely to see prices go up to the $3.50 to $4 range, which from here, on a percentage basis, is a very nice rally. So I'm bullish on natural gas here. One last thing about natural gas. I was talking about UGAS, which is the Velocity shares 3 times natural gas ETN. Well, last week they announced that as of September 10th, they are going to do a 1-for-5 reverse split. So now I'm more positive towards the UNG, which is the unleveraged ETF product in natural gas. On September 8th, I had an article come out through Seeking Alpha called The Modern Gold Market and Enigma. And gold, actually on this chart, gold is showing 1121.40 per ounce where it was yesterday and early this morning. And as we speak, it is trading at 1106. So it has dropped almost $20 today. And I haven't liked gold for a while. I think that gold is very heavy. There's divergences in gold. The silver gold ratio is above 55 to 1. As a matter of fact, it's over 75 to 1, which tells me that gold's too expensive. The platinum is trading at a discount to gold, which tells me that gold is too expensive here. So those inter-commodity spreads are weighing on the price of gold here. Gold is out of fashion these days, and in a global deflationary environment, the price of all assets go down, and I think that's what we're seeing, and gold is doing the same thing. Now, it's an enigma because paper gold has exacerbated moves over past years. We saw gold get up to $1,920 an ounce, and that was probably an extension because of all the gold ETF and ETN products that are out there, like the GLD, the IAU, that trade on stock exchanges, that make gold investment available to people who never had it available to them before, who would have to go to the futures market or who would have to go to the physical market, and who did not do that. So I think that this paper gold exacerbates moves, and it did so on the upside, and I think it might very well do so on the downside. Now, if gold is a commodity, it's going to go lower because all commodity prices are going lower because of China, because of a strong dollar, a bear market in commodity prices. And gold has held up well, but it's showing signs of faltering. So if it's a commodity, it's going to tank. If gold's a currency, on the other hand, it could rally because gold is actually the ultimate currency in the world. Central banks hold it. It is the only real pan-global accepted currency by the virtue of the fact that central banks hold it as part of their foreign currency reserves. Now, we saw on August 24th when the stock markets tanked and when China contagion hit all markets, gold spiked up to 1170, which was resistance, but it could not get through there. And since then, it's almost $65 today where we are, and that bodes poorly. But schizophrenia reigns supreme in this yellow metal that wears two hats. The hat is a currency, the hat is a commodity. And folks, for me, gold is very much a commodity these days, and that's why my target on gold is $880 per ounce. Crude oil. What can you say about crude oil? Well, I said it in the title of my article that came out on Seeking Alpha on September 8th. Crude oil is a psychotic horse in a burning barn these days, which means that it's very volatile. Crude oil is the horse. The burning barn is the global economic landscape. With China so weak, with OPEC pumping so much oil, with China so weak, the demand side is a problem in oil. With China is the demand side of the equation in commodities, and with 1.36 billion people, they consume a lot of oil. Now, on the supply side, U.S. production has been very high. It's over 9 million barrels per day. Now, it will go lower because rig counts are lower, but that's not the case for OPEC production. OPEC has decided not to cut production. They decided that at their November meeting. They reiterated that at their June meeting, and oil has done nothing but go lower. It made low end of August at 37.75 on August 24th. Since then, we've bounced out of there. We're at 44.5 roughly today on the active month NYMEX futures contract. But on the supply side of the equation, OPEC has a ceiling of 30 million barrels per day, but they're actually in July and August they pumped and sold 31.5 million barrels a day, which is much above the ceiling. Now, also with the Iranian agreement that's coming to force soon, and sanctions will be lifted, that's an additional at least 500,000 barrels a day, which will bring total OPEC production up to 32 million barrels per day. That weighs on price. The Russians are also producing over 10 million barrels a day. That supply weighs on price. So this is the bear case going forward. Lower demand from China, biggest commodity consumer in the world, higher supply from oil producers. Now, the bull case going forward, which is what makes it the psychotic horse in the burning barn, is where oil is produced. It is produced in the Middle East, and this is a very volatile region of the world. The Saudis and Iranians, both OPEC members, are fighting a proxy war in Yemen today. And Yemen has a long border that stretches along the Saudi Arabia territory. And on the other side of that border is a tremendous amount of oil production capability and refining capability. If that war spreads, you can expect spikes in the price of oil. And in other areas, in Iraq, in Iran, in all of the Middle Eastern countries, there is a lot of turbulence. And temperature has been rising with lower oil prices because these governments have to cut back. And as the temperature rises politically, violence usually ensues. Now, this can affect the price of oil if we see actual violence. It can also affect the price of oil in that logistical routes, such as the Persian Gulf, the Gulf of Aden, all of these important places where oil goes through are affected by problems in the Middle East. Now, that's the bullish case. Also, the fact that rig counts in oil have been dropping like a stone. Last year, a year ago, we had over 1,600 rig counts for oil going in the U.S., according to Baker Hughes. Last Friday, we were at 662. This will eventually translate to lower U.S. production. And perhaps OPEC, when U.S. production falls, they will cut production because they're getting a lot of heat from their members who are not rich countries, members like Venezuela, Algeria, Ecuador, Libya, who rely on oil revenues, who are having a very tough time. Look, I used to work for probably the world's greatest oil trader. I worked alongside him for 7 years. And Andrew J. Hall has had a rough time with lower oil prices. He reported losses of 17% in July. That was his second largest loss ever at Aston Beck Capital. He probably lost more in August. And he said in his latest report to investors that the world, whilst moderately oversupplied, is not awash in oil, and that he thinks that there's still room to store an additional 200 million barrels of crude here. And today's price reflects a worst case scenario. I know Hall very well. For the greater part of the 1990s, I sat next to him every day. I ate lunch with him. I ate dinner with him. I traded with him. He's a brilliant trader, and he's an expert analyst when it comes to understanding the balance sheet for crude oil around the world. He also takes an enormous amount of risk, usually in front-to-back spreads. He usually buys the front and sells the back. And there are times when the market hands him enormous pain, like now. But he has patience, and he is right far more than he's wrong. Therefore, I don't discount anything Andy Hall says, and I pay close attention, as many others do. Therefore, I think that volatility is likely to continue in this crude oil market, and where crude goes, many other markets will follow. Remember, the Dow Jones Industrial Average, the Russell, the S&P 500 contain a tremendous amount of oil patch stocks. So when crude oil goes down, these companies do worse. And when these companies do worse, their stocks go down, and that brings the averages down. So in addition to problems from China, contagion from China, crude oil is also causing volatility in the stock market. The bottom line, folks, is I expect this psychotic horse in the burning barn crude oil to keep bucking, and I expect that to add volatility in all markets. So those are my articles this week on Seeking Alpha. If you have any questions or comments, you can always email them to Martin Chronicle, and I'll see you next time. Look forward to it.